Good afternoon to everyone today. Welcome to our July edition of our webinar series. Today we have a very fascinating topic for you. For all of you lovers of compliance, we're going to show you how to fine-tune your compliance program by avoiding some of the common compliance violations. And we have a very interesting set of speakers. I'm going to announce them shortly. But before I do that, I want to give you a few administrative announcements. So what we want you to do, as always, please adjust the volume on your computer so that you can hear this conference. If at any time you want to resize the window so that you may see this well, drag the right side, the bottom, so that you can do that from this site. We also ask that you allow pop-ups. At any time during this webcast, please ask us questions of our panel. In fact, you can use the Ask a Question feature that's on the left-hand corner of your console. And as always, we're going to push out a survey to you at the end of the webcast. You don't need to watch your email. We're going to push it out to you here in the console. And of course, in 3 weeks, we're going to close caption this webcast for on-demand viewing. My name is Catherine Baxter. I'm going to be one of your moderators today along with Diane Rector. And before we get started, I want to give you our disclaimer for NCUA that we have to read. It says this webinar is offered for informational and educational purposes only. NCUA does not endorse any particular credit union or vendor or their employees' products or services. So as I mentioned, this is a special webcast for us today. I'm going to introduce our webinar team from NCUA. First and foremost, we have Judy Graham, who is a program officer with the Office of Examination and Insurance. We also have Patrick Truitt. Patrick is an information systems officer also with the Office of Examination and Insurance. And we have Matthew Nixon, who is a consumer compliance policy and outreach officer with our Office of Consumer Protection. At this point, I'm going to ask one of our panel, Gigi Bahur, to announce our NAFQ speakers.
Thank you, Catherine. I'm Gigi Bahur, and I'm NAFQ's Director of Regulatory Compliance. Also here today is Bernadette Clare, Senior Regulatory Compliance Counsel. Before we get started, I just wanted to quickly read NAFQ's disclaimer. The information contained in this presentation is intended to provide general compliance information in regard to the subjects covered. It is provided with the intent and understanding that NAFQ staff is not engaged in the act of rendering legal, accounting, or any other professional advice. The information provided during this webcast is not intended nor should be issued as a substitute for legal advice or other expert opinions and services in the specific situations. Moving on to the agenda, today's webcast will cover common violations found under the Bank Secrecy Act, lending violations, specifically with fair lending, and other lending requirements such as flood and the SAFE Act. We'll also discuss safeguarding member information and also the most common violation found under the privacy regulations.
Okay, thank you, Gigi. One of the things I'd like to tell the audience is this particular webcast, you will be able to get a certificate of attendance. Now, here's what you'll have to do in order to get that certificate. You will have to answer 3 of the 4 polls. Now, the first poll that we're going to push out is a general poll. Don't worry about that one. But there are 4 more polls after that. Also, you'll need to answer correctly 12 of 15 quiz questions. You'll notice on your console that there are 2 magenta icons. One will show you your progress. That's the one that's nearest to your left. The other one will have the test information on it. So once the webinar is concluded, you can, at that point in time, begin taking the test. Another requirement is that you must be on the call for at least 45 minutes. So let's go to our first poll question. Again, this poll question doesn't have anything to do with the requirements, but let's go to that. And I know I put Gigi on the spot when I initially asked her to introduce herself, but thank you anyway for doing that. So here's our first poll question. We want to know what asset size we have with us on the call today. So if you are a credit union, is your asset size less than $1 million? Is it between 1 million and 10 million? Is it between 10 million and 100 million? Is it between 100 million and 500 million? Or greater than 500 million? And then, if you're not a credit union, please also select that. You may select the answer on your screen, and what we're going to do is see what we have thus far. All right, so let's push out our results to our audience. Let's see. I think we're having a little bit of technical difficulty here because I don't think everyone can see what we have. Let's see. Let's try this again. Do we have it? Well, what we have so far, we have quite a few that are on the call that are between 10 million and 100 million, also from 100 million to 500 million, and we have quite a number that are greater than 500 million. All right, so let's get started. I'm going to turn our first section over to Judy Graham, and she's going to talk to you about Bank Secrecy Act compliance. Judy?
Thank you, Catherine, and good afternoon, everyone. We're having a little bit of technical difficulty, but I'm going to go ahead with my presentation with the Bank Secrecy Act. NCUA regarding the Bank Secrecy Act. The Federal Credit Union Act requires NCUA to conduct a review of the Bank Secrecy Act compliance program at each examination of a federally insured credit union. Now, the compliance program at the credit union is governed by Part 748.2 of NCUA's Rules and Regulations that requires every federally insured credit union to establish a BSA compliance program that establishes internal controls, provides for independent testing, designates a BSA compliance officer, and establishes a BSA training program. And also Part 748.2 requires every federally insured credit union to establish a customer identification program, which I know that within the credit union industry is commonly referred to as a member identification program, but since the regulation calls it customer identification program, that's how I will be referring to it throughout the presentation. Now, I'm going to discuss the Customer Identification Program, or CIP. It must be written and board approved, and it is intended to enable the credit union to form a reasonable belief that it knows the true identity of each member at account opening. The Customer Identification Program must also be appropriate for each credit union size and type of business and must include certain minimum requirements. Now, the CIP must contain account opening procedures detailing the identifying information that must be obtained from each member. At a minimum, the credit union must obtain the following identifying information from each member before opening the account. The name, date of birth for individuals, physical address, and an identification number. Now, an identification number would generally be a Social Security number for individuals, and if it's for a business account, it would be their employer identification number. Now, as I mentioned a little bit earlier, the CIP must contain risk-based procedures for verifying the identity of the member within a reasonable time period after the account is opened. The credit union may use documentary or non-documentary methods or a combination of both methods to verify the information obtained, but it must verify enough information to form a reasonable belief that it knows the true identity of the member. And I'm going to discuss some documentary and non-documentary methods in a little more detail on the next slide. The CIP must also include record-keeping procedures, which at a minimum, information obtained at account opening must be retained for 5 years after the account is closed. There are some other retention periods I'm not going to go into that at this point, but you can refer back to the regulation or the CIP section in the FFIEC BSA AML examination manual. And the CIP must also include procedures for determining whether the member appears on any federal government list of known or suspected terrorists or terrorist organizations. And the CIP must also include procedures for providing members with adequate notice that the credit union is requesting information to verify their identities. And this notice may be posted in the lobby, at the teller stations, or posted on the website, or in some other manner, such as giving it to the member in a new member information packet when they open their account. Now, for the verification methods that the credit union can use, as I said earlier, the verification methods must enable the credit union to form a reasonable belief of the true identity of the member. Your credit union's procedures must describe when it will use documents, when it will use non-documentary methods, or whether it will use a combination of both methods. The general expectation for using documentary method is for an individual is for the credit union to review an unexpired government-issued form of identification that provides evidence of a member's nationality or residence and bears a photograph or similar safeguard. For businesses, for a documentary method, would generally be documents showing the legal existence of the business, such as articles of incorporation, some type of government-issued license, partnership agreement, or a trust agreement, or other types of business documents. Now, for non-documentary methods, credit unions are not required to use non-documentary methods, but if they do, they must have the procedures set forth within their policies, and they must address the following situations where they would use those non-documentary methods, such as if the potential member was unable to produce a government ID at account opening, or if they produced or provided documents that the credit union is unfamiliar with, such as a passport from another country that the credit union may not be familiar with. Also, there should be procedures established if there are accounts that are not opened in person, such as allowing members to open accounts online. Also, you should address any situations where you feel that additional verification may be needed, or also address situations if there is a lack of verification and if the member is unable to produce any of these documents. And the situations the credit union should address would be if there is a lack of identification or the credit union is unable to verify the identification of the member, will they open the account? If they do open the account, will it be placed on some sort of a watch list or a hold for a certain amount of time? Will transactions be limited for a certain amount of time until the verification is complete? And also, will the credit union close the account after a certain period of time if they are unable to verify the identity of the potential member? So that concludes my discussion of the CIP section. And at this point, I'm going to turn the presentation over to Gigi Bahor from NAPCU. She's the Director of Regulatory Compliance, and she's going to discuss more of the common violations related to BSA.
Thank you, Judy. The currency transaction report is next, and it's often cited for violations during NCUA examinations. Some examples include untimely filing, inaccurate form completion, structured activity not being monitored, and inadequate retention of CTR copies and supporting documentation. A number of these violations can be avoided just by knowing some of the basic filing requirements and ensuring that there are procedures and staff in place, such as having a BSA officer who can ensure that the procedures are being implemented. A credit union must file a CTR for each transaction in currency of more than $10,000 by, through, or to the credit union. More than $10,000 means $10,000 and a penny. There are exemptions from CTR reporting, but for today's purposes, we won't be going into that detail. The requirement to file a CTR may also surface where there are multiple currency transactions totaling more than $10,000 during any one business day. If the credit union has knowledge that these transactions are being completed by or on behalf of the same person during the same day, the transactions are to be aggregated and treated as a single transaction. It's important that credit union staff is aware of and alert to potential structuring schemes, since money launderers and criminals have over time developed many ways to structure large amounts of currency to evade the CTR filing requirements. Credit unions are strongly encouraged to develop systems that are necessary to aggregate currency transactions throughout the institution. Management should also ensure that there's an adequate system that is implemented that appropriately reports currency transactions subject to the BSA requirement. One of the most cited BSA violations is untimely filing, both for the CTR and the suspicious activity report. A completed CTR must be filed with FinCEN within 15 calendar days after the date of the transaction. Credit unions must use a specific CTR form and file it electronically through FinCEN's e-filing system. Record retention is another issue where CTR violations stem from. Credit unions must retain copies of CTRs and supporting documentation for 5 years from the date of the report, and the credit union can retain either hard copies or copies in electronic format. Okay, the Suspicious Activity Report, or SAR, is another BSA form that causes a number of common violations during an examination. Specifically, common violations include untimely filing, inaccurate completion, improper retention, and failure to notify the board of SAR filings. You'll notice that 3 of those 4 violations are the same violations you saw with the CTR. Like the CTR, a number of these violations can be avoided by knowing the basic filing requirements for the SAR and also ensuring that there are procedures and staff in place who are ensuring that the procedures are being implemented. While it may not be possible for a credit union to detect and report all potentially illicit transactions that flow through the credit union, there are certain activities that that credit unions are required by federal regulations to file a SAR on. Specifically, a credit union is required to file a SAR with respect to criminal violations that involve insider abuse in any amount, criminal violations aggregating $5,000 or more when a suspect can be identified, criminal violations aggregating $25,000 or more regardless of whether or not the credit union can identify the suspect, or transactions aggregating $5,000 or more that are conducted or attempted by, at, or through the credit union if the credit union knows, suspects, or has reason to suspect that the transaction either involves potential money laundering or other illegal activity, or it's designed to evade the BSA or its implementing regulations, or it has no business or apparent lawful purpose, or is not the type of transaction that the particular member would normally be expected to engage in. As I mentioned, these threshold items require by regulation that a SAR be filed. All other decisions to file a SAR is a subjective process, meaning that the credit union should have an established SAR decision-making process. When a credit union has an established SAR decision-making process and it has followed existing policies and procedures and also has determined not to file a SAR, the credit union should not be criticized for the failure to file a SAR unless the failure is significant or accompanied by evidence of bad faith. But as I said, there are many other suspicious activity. There may be other suspicious activity that the credit union should file a SAR on, so it is really important that the credit union's training and processes are adequate so staff is able to identify, evaluate, and report suspicious activity when it does exist. Like the CTR, the SAR must be filed electronically through FinCEN's e-filing system. SARs, however, must be filed no later than 30 calendar days from the date of the initial detection of facts that may constitute a basis for filing the SAR. And if no suspect can be identified, the time period for filing a SAR is extended to 60 days. There is also a board component to SAR filing. Credit unions are required by NCUA SAR regulations to notify the board of directors or an appropriate board committee that SARs have been filed. The regulations don't provide or mandate a particular notification format, so the credit union does have flexibility in structuring that format. For instance, one credit union may provide actual copies of SARs to its board, whereas another may opt to provide summaries or a table with specific violation types or something of that nature. Regardless of the format that is used, management does need to provide sufficient information on SAR filings to the board so that the board can fulfill its fiduciary duties to the credit union and to the credit union's members. That being said, it should also be noted that SARs are confidential. No credit union and no director, officer, employee, or agent of the credit union may notify any person involved in the transaction that the transaction has been reported. This is true even if the credit union is subpoenaed, except when the disclosure is requested by FinCEN, an appropriate law enforcement, or NCUA. And then the last thing I'll mention about the SAR is that, like the CTR, credit unions must retain copies of SARs and supporting documentation for 5 years from the date of the report. Next, I'd like to introduce Bernadette Clare from NAFCU. She is Senior Regulatory Compliance Counsel, and she will discuss other common violations cited under BSA.
Thank you, Gigi. Next, we're going to talk about a couple of common BSA violations that speak to internal control issues. The first one deals with risk assessments, and these violations generally include when a credit union has not completed a risk assessment or the risk assessment is outdated or inadequate. For example, maybe it doesn't cover all of the credit union's operational areas. The second area concerns independent testing. These violations include independent BSA testing or audits that have not been performed or audits that were deficient for some reason. For example, if the audit wasn't performed by an independent party or a qualified party or both. We'll start with the risk assessment. The risk assessment is driven by the basic requirement to have a BSA program reasonably designed to ensure compliance. As Judy discussed earlier, we know that NCUA's rules require that credit unions have a written, board-approved compliance program that includes, at a minimum, CIP and the 4 pillars: internal controls, independent testing, a designated BSA officer, and training. Assessing BSA risk is really the foundation to determining what controls need to be in place. If you don't know what your risks are, then it's difficult, if not impossible, to know if the controls you have in place are mitigating your risk or that your program is reasonably designed to ensure compliance. So the risk assessment is a tool for taking a comprehensive look at the BSA and money laundering risks in your credit union. Every credit union is going to have its own risk profile, or your credit union's fingerprint, so to speak. There isn't a particular prescribed format for the risk assessment. That will be up to the credit union, but it should be thorough in its analysis and presentable in an organized and understandable manner so that it can be shared within the credit union as appropriate. For example, with senior management, the board, and relevant business lines or operational departments. The FFIEC BSA AML Examination Manual has a section specifically dedicated to the risk assessment process that explains supervisory expectations and addresses best practices. One of those best practices is to put the risk assessment in writing for utilitarian reasons, obviously, because it makes it easier to present and work from the analysis, but it also serves to document all of the work that you put into analyzing and managing your BSA risk. Keep in mind that the NCUA is required by law to review your BSA program at each exam, and your risk assessment plays an important part in helping the examiner understand what your risks are and how you mitigate them. On the flip side, if a credit union has not completed a risk assessment, the examiner is going to have to do it based on the information that is available to them. And you might not like or agree with the results of that risk assessment. So a credit union is going to be in a much better position if it has taken the time to assess its own risks. You know your own operations, your members, your risks, and how you manage them better than anyone else. So make sure the risk assessment is done and make sure it's documented. Now, let's talk about the risk assessment process itself. There are a couple of steps involved in developing a risk assessment. First, identifying the specific risk categories in your credit union, and second, assessing the risks within these categories. For specific risk categories, this means identifying products, services, the types of transactions you offer, considering the characteristics of your membership, as well as your geographic locations, because that can impact your risk as well. The goal is to make sure that you have accurately identified where your credit union's specific BSA and money laundering risks are. For example, some products are higher risk than others. Products and services that allow money to move quickly or are more susceptible to anonymity or involve a high volume of currency are more likely to be higher risk. Things like prepaid cards, wire transfers, especially if they are international wire transfers, third-party payment processors, ACH, ATM transactions, online banking, monetary instruments, all these different types of products and services potentially carry different risks. And what you're trying to do here is identify what products and services you have that may pose higher BSA risks. Your members, too, can represent varying amounts of risk. It's one thing to have accounts for natural person members, and the accounts are just regular consumer household accounts. And it's another thing to have a large number of accounts for money services businesses, which we'll talk about a bit later. Certain professions historically have a tendency to be more vulnerable, such as attorneys, accountants, doctors, real estate brokers. Charities, cash-intensive businesses also tend to be more vulnerable, to name just a few. The point is that your membership or segments of your membership could have characteristics that represent different levels of potential or actual risk. And don't forget about your locations as well. For example, are you in a high-intensity drug trafficking area or a high financial crime area? These are all factors to consider when assessing risk. It's not to say that every member who's in one of these areas or any of the services I mentioned are necessarily high risk for you, but these are the kinds of characteristics that need to be considered. The second aspect of this, once you've identified your risk categories, is to really assess what your risk is. What kind of transaction volume do you have? What is your CIP and due diligence like? Do you facilitate 20 international wires or do you do 1,000 in a year? And who are you facilitating them for? So what you're really answering in step 2 is what is your actual risk? And then once you've got your risk assessment, you can determine what controls you need to have in place to manage those risks. So you can see that this risk assessment, once it's completed, is going to be unique once you've factored in all the characteristics specific to your credit union. Another aspect to keep in mind is that the risk assessment process never really ends. It can't be done once and then forgotten about because risks don't stay the same. As I mentioned, some of the violations have been that a credit union did a risk assessment, but it was too long ago and it hasn't been revisited. So we need to reevaluate risks periodically and as they evolve. Certainly, if there is some sort of major change for your credit union, maybe you are merging in another credit union, your field of membership has changed, you've overhauled your products, maybe you've really made a push towards mobile transactions, any big change could mean that risks need to be reassessed. If you look at the FFIEC manual, the recommended time frame is at least every 12 to 18 months. Now that's kind of a general recommendation in the absence of any major change. And then if there is a major change, reevaluation may be necessary at that time as well. With regard to the 12 versus 18 months, most credit unions are probably looking at every 12 months. For 18 months, I think you'd probably have to have very minimal BSA risk to be able to push it out that far. And finally, this slide just sums up a lot of what we've been talking about and the idea that risk is always changing. So, we're evaluating our risks, we implement controls to manage those risks, and then we evaluate how those controls are working and how our risks are changing, and that's an ongoing cycle. Moving on to independent testing, which is a second area of common violations related to internal controls. A periodic audit or test of a credit union's BSA program needs to be completed every 12 to 18 months, commensurate with the credit union's risk profile. So again, like we were talking about risk assessments, 12 months is probably going to be the norm for most credit unions. Pushing it out to every 18 months would probably be limited to small credit unions with very low BSA risk. Some audits have been deficient because they were either performed by someone who is not truly independent or by someone who is not qualified to perform it. So for example, if a credit union uses outside consultants to help develop its BSA policies and procedures, then that same consultant shouldn't be performing the testing because they are not truly an independent party. They helped you set it up. The same holds true if the test is being conducted in-house. Certainly you can use in-house staff, but you have to make sure that the employees testing it are not involved in setting up the program. For example, if your compliance team helps you put together your BSA program, then it might need to be your internal auditor that is testing the program. The other aspect to consider is the scope of the audit. While the audit itself is risk-based, it should still encompass the entire credit union. The frequency and depth of the audit in a particular area should vary according to the risk, but the audit should be looking at the overall adequacy and effectiveness of the program, including policies and procedures. It should also include a review of the risk assessment for adequacy, include transaction testing, a review of BSA training, and the effectiveness of suspicious activity monitoring systems or processes. Some of the issues with deficient audits have been in this area. For example, maybe there's a whole segment of operations like ACH activity or wire activity that wasn't considered at all. And that would be an example of an audit that's deficient. Another area commonly cited for BSA violations is inadequate training for credit union staff or the board. The regulatory requirement is to provide training for appropriate personnel, and that essentially means that all personnel whose duties require knowledge of the Bank Secrecy Act should be included in the training program. Now, since job functions vary, the training that people need is also going to vary. So one of the important aspects to consider in training is that it should be tailored to the position. So for example, if you are training tellers, they are going to need to know when and how to fill out a CTR, or what your credit union specific procedures are for handling CTRs. If you're training lending staff, then maybe you want to take a look at some of the money laundering red flags that are associated with loan transactions. Or for new employees, do they receive an overview of what the BSA is all about? The board also needs to receive BSA training. After all, they are ultimately responsible for the credit union. So for the board, they need to know what the latest changes are in the law and regulations. They need to understand the importance of BSA requirements, ramifications if the credit union doesn't comply, and what the credit union's BSA risks are. That's all important so that they can fulfill their oversight duties, and so on. These are just a few examples of tailoring the training for the specific responsibilities of the individual. Another area that is often cited is 314A violations, particularly the failure to comply with the record search requirement within the required time frame and failing to maintain a current point of contact. Now, as background, 314A is a section of the Patriot Act that allows law enforcement to ask FinCEN to solicit financial institutions for information on its behalf. This process is generally limited to law enforcement investigations related to terrorist activity or money laundering, and it's usually where law enforcement has come to a dead end in its investigation, and now it's asking FinCEN to ask financial institutions if they have any information on these suspects. So the law enforcement agency has to provide a written certification to FinCEN attesting to credible evidence of engagement in terrorist activity or money laundering by the suspect or suspects. FinCEN will then post a 314A subject list through the web-based 314A Secure Information Sharing System. They do this every 2 weeks or more frequently for an emergency request. A credit union's designated point or points of contact will receive notification from FinCEN that there is a new posting to FinCEN's secure website. When a credit union receives notification of an information request, it must conduct a one-time search of its records to identify accounts or transactions of any named suspects. Unless otherwise instructed by the information request, a credit union must search its records for current accounts, accounts maintained during the preceding 12 months, and transactions conducted outside of an account by or on behalf of a named suspect during the preceding 6 months. The credit union must report any positive matches to FinCEN within 14 days, unless otherwise specified in the information request. No details should be provided to FinCEN other than the fact that the financial institution has a match. Now, with regard to the second common violation, not updating the point of contact for the credit union, This is something that can be updated electronically through Credit Union Profile in the CU Online system on NCUA's website. A credit union needs to have at least one designated point of contact and can designate up to 4 points of contact in Credit Union Online. Next, we're going to talk about money services businesses and some of the issues related to maintaining accounts for these businesses at your credit union. First, it's helpful to spend a minute talking about what we mean by money services businesses, or MSBs. The definition of an MSB includes businesses like check cashers, foreign currency dealers, issuers and sellers of traveler's checks or money orders, providers of prepaid access, money transmitters, and sellers of prepaid access. There is also generally some dollar thresholds that apply to this activity. For example, for a lot of these, the threshold is $1,000. So if they don't engage in these types of transactions in amounts greater than $1,000 for any one person on any one day, then they are not considered an MSB. Prepaid access is a bit more complicated, but we won't get into those details here. However, if a credit union is considering these accounts, then you definitely want to take a look at FinCEN's rules, the FFIEC BSA AML examination manual, and specifically NCUA's letter to credit unions 14-CU10 and the enclosed supervisory letter. Of course, MSBs can and do provide valuable services to the communities that they're in, and credit unions can maintain accounts for MSBs within their field of membership. But if a credit union chooses to do so, it needs to make sure it has assessed the potential risks involved and taken appropriate steps to manage and mitigate those risks. Not all MSBs pose the same risk. They differ in size, the types of transactions they offer, the locations in which they offer them, and transaction volume. So there really isn't a one-size-fits-all approach, and it's got to be tailored to the risk. It's also important to note that MSBs are subject to their own regulatory requirements, such as FinCEN registration if they meet FinCEN thresholds and state-specific supervisory requirements. From a regulatory perspective, it's important to note that credit unions are not responsible for their member MSBs' compliance with the BSA and other applicable federal and state laws and regulations. Credit unions are not a de facto regulator for their members. However, credit unions are expected to manage the risk associated with any MSB account that they maintain. So minimum due diligence expectations include such things such as performing the required CIP procedures, confirming that member MSBs register with FinCEN if they're required to do so, confirming that member MSBs comply with state or local licensing requirements, and confirming the member MSB's agent status if applicable. And in addition to that, conducting a BSA AML risk assessment to document the level of risk associated with the account and to determine whether greater due diligence is necessary. Things to consider in the risk assessment include the types of products and services offered by the MSB, the locations served by the MSB, anticipated account activity and volume, and the purpose of the account. And then based on the risk assessment, you may decide that you need to put in place additional due diligence requirements. And finally, these are the types of controls to implement if your credit union wants to maintain MSB accounts. Make sure that you've got controls to properly identify member accounts as MSBs, that you conduct adequate and ongoing due diligence of the MSB relationship, and you want to make sure that your MSB accounts are included in the credit union's suspicious activity monitoring and reporting systems. And definitely, I would say take a look at NCUA letter to credit unions 14-CU10. It has examples of both low and high risk factors to consider when assessing risks of an MSB member, and it gives you a good idea of how an examiner will look at these accounts. Now we're going to shift gears a bit, but first I'm going to turn it over to Catherine for our first polling question.
Thank you, Bernadette. As Bernadette mentioned, this is the first polling question that counts towards the 3 out of 4. So here's the question, and we have our compliance team here to make sure we stay online with it. The BSA compliance program need only be reviewed every 5 years. True or false? So please make your selection on your screen, true or false. And also, I want to remind everyone, if you'd like to download this presentation, there is a green folder at the bottom of the screen. You may click on that, and you may download this PowerPoint presentation for your records. And also, because of the fact that we have a long session today, we will answer some questions as we go along, but we will not have a Q&A session at the end. So let's see what our audience said to the question. Well, everyone says that 5 years is not the time frame. So I'm going to ask our compliance team here, are they correct?
Yes, that is correct.
Judy, did you have anything you wanted to add?
No, I certainly agree with Gigi, but that is false. The credit unions should be reviewing their BSA compliance program pretty much on an annual basis. But if they are adding new products and services, or if they're adding new field of membership, or possibly taking in another credit union in a merger that may have products and services or members or a type of business member, something that the credit union doesn't have, they should also review and update their BSA compliance program at that time.
All right, you heard it. So now we are going to switch gears, just like Bernadette said, and we're going to go into fair lending. So Matthew Nixon from the Office of Consumer Protection is going to entertain us with that. Matthew?
Thank you, Catherine. This afternoon, in my discussion of fair lending compliance, I'll talk about laws and regulations that govern fair lending. I'll discuss NCUA's Fair Lending Examination Program, and I'll talk about common errors noted in examination reports and supervision contacts. So what is fair lending? The Dodd-Frank Act defines fair lending to mean fair, equitable, and non-discriminatory access to credit for consumers. Treating certain consumers less favorably than others on a prohibited basis is unlawful. I'll discuss the factors that are prohibited bases for discrimination under federal fair lending laws later in the presentation. At the federal level, there are 3 laws related to fair lending. The Equal Credit Opportunity Act, or ECOA, which is implemented by Regulation B, the Fair Housing Act, which is implemented by regulations issued by the U.S. Department of Housing and Urban Development, and the Home Mortgage Disclosure Act, or HMDA, implemented by CFPB's Regulation C. ECOA and the Fair Housing Act list factors that you cannot use to discriminate in connection with covered activities. HMDA seeks to promote fair lending by requiring public disclosure of certain information about loan applications. ECOA prohibits discrimination in any aspect of a credit transaction on the basis of race or color, religion, national origin, sex, marital status, age, the applicant's receipt of income derived from any public assistance program, and the applicant's exercise in good faith of any right under the Consumer Credit Protection Act. The Fair Housing Act prohibits discrimination on a prohibited basis in residential real estate related transactions. The Fair Housing Act prohibits discrimination on many of the same bases as ECOA: race, color, national origin, religion, and sex. The Fair Housing Act prohibits discrimination on the basis of familial status or handicap, which are not prohibited bases under ECOA. Also, certain prohibited bases under ECOA are not prohibited bases under the Fair Housing Act, such as marital status and age. The Home Mortgage Disclosure Act requires financial institutions, including credit unions, to compile and disclose data about home purchase loans, home improvement loans, and refinancings that they originate or purchase, or for which they receive applications. HMDA data is used to help determine whether financial institutions are serving the housing needs of their communities, to assist public officials in distributing public sector investment, and to assist in identifying possible discriminatory lending patterns. Federal credit unions cannot advertise in a way that discriminates on a prohibited basis. Advertisements must not contain any words, symbols, models, or other forms of communication that suggest a discriminatory preference or policy of exclusion on a prohibited basis. Any federal credit union that advertises real estate-related loans must prominently indicate that the credit union makes such loans without regard to race, color, religion, national origin, sex, handicap, or familial status. For written and visual advertisements, a federal credit union may satisfy this requirement by including an equal housing lender logo or an equal housing opportunity logo as described in the regulation. For oral advertisements, a federal credit union may make a spoken statement that the credit union is an equal housing lender or an equal opportunity lender. Also, a federal credit union that engages in real estate-related lending must display a notice of non-discrimination in the public lobby of the credit union and in the public area of each office where such loans are made. Next, I'll discuss NCUA's Fair Lending Examination Program. NCUA operates a fair lending examination program that is separate from the agency's safety and soundness exam program. Generally, we touch about 75 credit unions annually with fair lending reviews, and we have two types of fair lending reviews. We do fair lending examinations, and we perform fair lending supervision contacts. For fair lending exams, we generally complete about 25 per year. This is an on-site examination. We're generally on-site for approximately 2 weeks, and our examinations do include transaction testing. So we will pull loan files, adverse action notices, other source documentation to allow us to assess compliance with fair lending laws. Our fair lending examinations follow the guidance issued by the FFIEC's Interagency Fair Lending Examination Procedures. For supervision contacts, we perform approximately 50 per year. This is an off-site review of the credit union's fair lending compliance management system. It does not include transaction testing, and it generally takes our analysts and examiners approximately 3 days to complete. Our fair lending examination program uses a risk-based approach for selecting credit unions. And we review the following risk areas to assess which credit unions we will select. We look at HMDA data, we review member complaints, prior regulatory violations, a credit union's compliance risk rating, whistleblower complaints, and we also take recommendations from field examiners. Next, I'll discuss common HMDA and ECOA errors noted in examinations and supervision contacts. Concerning HMDA reporting, we frequently see misreporting of applications withdrawn. Application withdrawn may be used only when the application is expressly withdrawn by the applicant before a credit decision is made. The application withdrawn code may not be used when you communicate a credit decision to the applicant, ask if the applicant wants to proceed, and then the applicant afterwards withdraws the application. Applications that are closed for incompleteness or approved but not accepted may not be reported as application withdrawn. The action to withdraw must be taken by the applicant, not the credit union. We also see frequent misreporting of counteroffers in HMDA data. If a credit union makes a counteroffer to lend on terms different from the applicant's initial request, for example, a shorter loan maturity or in a different amount, and the applicant does not accept the counteroffer or fails to respond, the credit union should report the action taken as a denial. If the counteroffer is accepted, the credit union reports the application as an originated loan. Continuing with HMDA reporting, we also see frequent errors with reporting of conditional approvals. If a credit union issues a loan approval subject to the applicant's meeting underwriting conditions other than customary loan commitment or loan closing conditions, and the applicant does not meet them, the credit union should report the action taken as a denial. For the purpose of this slide, customary loan commitment or loan closing conditions include clear title requirements, acceptable property survey, acceptable title insurance binder, clear termite inspection, and where the applicant plans to use the proceeds from the sale of one home to purchase another, a settlement statement showing adequate proceeds from the sale. Continuing with HMDA reporting, we also see confusion over pre-approvals and pre-qualifications. Under Regulation C, a credit union must report pre-approval requests, but does not report pre-qualification requests. The difference between the two, under a covered pre-approval program, the credit union completes a comprehensive analysis of the creditworthiness of the applicant and issues a written commitment to the applicant valid for a designated period of time to extend a home purchase loan up to a specified amount. Now I want to discuss differences in government monitoring information, or GMI, collected under ECOA and Regulation B and reported under HMDA and Regulation C. Under Regulation B, the requirement to collect GMI applies to applications for credit primarily for the purchase or refinancing of a dwelling occupied or to be occupied by the applicant as a principal residence. A creditor must request as part of the application information about the applicant's ethnicity, race, sex, marital status, and age. The applicant must be asked, but is not required to supply the requested information, and a creditor must request this information even if it does not file HMDA reports. By contrast, HMDA addresses the collection of GMI as it pertains to race, ethnicity, and sex. Although a credit union does not request age or marital status under Regulation C, it must request this information under Regulation B. Per Regulation B, the credit union must inform the applicant that the information regarding ethnicity, race, sex, marital status, and age is being requested by the federal government for the purpose of monitoring compliance with federal statutes that prohibit creditors from discriminating against applicants on those bases. The credit union must also inform the applicant that if the applicant chooses not to provide the information, the creditor is required to note the ethnicity, race, and sex on the basis of visual observation or surname. If the applicant does not want to provide the information or any part of it, the credit union should note that on the form. I now want to discuss GMI under HMDA and Regulation C. For mail, internet, or telephone applications, if an applicant does not provide GMI, the credit union should use the code for information not provided by applicant in mail, internet, or telephone application. Also, a credit union must permit an applicant to fill in only one or two of the three fields, that is, ethnicity, race, or sex. If an applicant marks a box indicating the applicant does not wish to furnish GMI, but supplies some or all of the information, the credit union must report the information supplied. An applicant must also be permitted to select more than one race category, and the credit union must report all race categories selected. I now want to talk about Regulation B requirements for adverse action notices. The adverse action notice must include the name and address of the federal agency that administers compliance with respect to the creditor. We frequently see outdated information, such as the NCUA's regional offices being listed rather than the Office of Consumer Protection. We also frequently see other federal regulators listed on credit union adverse action notices, such as the Office of the Comptroller of the Currency. Continuing with adverse action notices, specifically timing of notices, for denials, an adverse action notice is required 30 days after receiving a completed application, 30 days after taking adverse action on an incomplete application, unless notice of incompleteness has been provided, and 30 days after taking adverse action on an existing account. For counteroffers, an adverse action notice is required 90 days after notifying the applicant of a counteroffer that the applicant does not accept. A credit union may provide a combined counteroffer and adverse action notice, and if the combined notice is given, then no additional disclosure is required. And finally, I want to talk about the adverse action notice requirement for statements of specific reasons for denial. Under Regulation B, the reasons given must be specific and indicate the principal reasons for adverse action. Statements that adverse action is based on internal standards or policies, or that applicants failed to achieve qualifying credit scores are insufficient. While the regulation does not require any specific number of reasons to be given, the commentary does say that more than 4 is not helpful. And finally, when denied because of an automatic denial factor, such as declaration of bankruptcy, the credit union cannot list the reason as an automatic denial factor. They should list the specific factor.
Okay, thank you, Matthew. And we have a lot of questions coming in, so at this point we're going to entertain one or two. So I'm going to push out a poll question to you too, but I'm going to ask Matthew if he doesn't mind me putting him on the hot seat and asking a question. We had some very good questions from our audience. So one of the questions that I'd like to ask, this is a fair lending question, and then we have a lot of BSA questions, of course. Here's a question number 91. Question number 91, Matthew, from a credit union. And they say that we are a state-chartered credit union, so here's my question. Which poster do we display, the equal housing opportunity or equal housing lender?
Thank you for that question. So in the presentation that I provided, I referenced the requirements for a federal credit union, and those requirements are addressed in NCUA's regulations. If you are a state-chartered credit union, the guidance for advertising is addressed in the Fair Housing Act, and that would be the reference that you would use for the display of the lobby poster.
Thank you, Matthew. Now I'm going to push out a question to our compliance team for BSA. And this is going to be question number 45. Question number 45 says, did you say we can keep the CTR and SAR electronically for 5 years or a hard copy only? So I'm going to, Gigi is going to answer first, and then Judy and Bernadette, if there's anything left.
Whether you keep the CTR and SAR electronically or hard copy is going to be a business decision for your credit union. But Judy and Bernadette, do you have anything else you want to say on that?
This is Judy. No, I agree with Gigi totally. You can either keep the CTR or SAR. It can either be kept electronically or it may be kept hard copy. That is a business decision for the credit union. However, that information and the supporting documentation must be kept for 5 years from the date of filing.
Fantastic. Here's another question, in all fairness, for our BSA team, because they've been sitting around and dying for questions. So here's another one. Question number 47. What is the deadline for a recurring SAR?
Okay, this is Bernadette from NAFCU, and I'll tackle this one. FinCEN does have some guidance on its website. It's generally 120 days, and that allows you a 90-day period to kind of review the activity and then 30 days to file. You can, of course, file it sooner than 120 days if you want, but that's kind of the max on recurring suspicious activity.
Okay, fantastic. So now let's push out the poll question. This is poll question number 3, and let's send it to the audience. Here's what it says. If a credit union makes a counteroffer different from the applicant's initial request and the applicant does not accept the counteroffer or fails to respond, the credit union reports the action as a denial. Is that true or false? So please select the answer on your screen. Keep those questions coming in. Our panel will answer your questions directly to you and also on our on-demand screen when we archive this in 3 weeks. So let's see what kind of answers we have right now. And we're going to turn it over to Matthew to see if they're correct. Are they correct, Matthew? Here's the answer.
Yes, that is correct. The answer is true. The credit union is denying the application based on the initial request.
Thank you very much. And now I think we're going to go to Bernadette, and she is going to talk about other common lending violations. Bernadette.
Thank you, Catherine. Now we're going to talk about a few common violations in the area of mandatory flood insurance requirements. Specifically, we're talking about the National Flood Insurance Act and National Flood Insurance Program and the requirements for loans in special flood hazard areas. For federally insured credit unions, Part 760 of NCUA's rules and regulations implement these requirements. There are a few common violations in this area. First off, not using the prescribed standard flood hazard determination form when determining whether the building is in a special flood hazard area and whether insurance is available. Second, if the building is located in a special flood hazard area, not notifying the borrower in a timely manner whether insurance is or is not available. And third, using old determinations for subsequent transactions, because while you generally can use a prior determination, there are some conditions that would need to be met in order to do so. As a reminder, the general rule is that a credit union cannot make, increase, extend, or renew any designated loan unless the building or mobile home and any personal property securing the loan is covered by flood insurance for the term of the loan. Now, there are a couple of exemptions. One deals with state-owned property covered under a satisfactory self-insurance policy, and the other deals with property securing a loan with an original principal balance of $5,000 or less and a repayment term of less than 1 year. When we look at the basic requirement, it's also important to note that designated loan is a defined term, and there are a couple of parts to that definition. One is that the building or mobile home is located or will be located in a special flood hazard area. And the second is that the community in which the property is located participates in the National Flood Insurance Program, or NFIP, meaning that flood insurance is available under the Act. So when you're dealing with a loan that meets the definition of a designated loan, then you're dealing with a transaction that is within the scope of the rule and subject to the mandatory flood insurance requirements. With regard to the amount of coverage, it must be at least equal to the lesser of the outstanding principal balance or the maximum available under the Act. The first common violation is not using the prescribed form for making the determination as to whether the building or mobile home that will be collateral for the loan is in or will be in a special flood hazard area, and if flood insurance is available. Use of the form is required, and it can be found on FEMA's website. Also, make sure that the credit union keeps a copy of the completed form, either the hard copy or an electronic copy, for as long as the credit union owns the loan, because retention is also required under the rule. Another common error is not providing notice to the borrower in a timely manner. This is the notice that you have to give a borrower if the building or mobile home is located in a special flood hazard area. The notice tells the borrower that the building is in a special flood hazard area and whether flood insurance is available under the Act or not. Now, the rule states that the notice needs to be provided within a reasonable time before completion of the transaction. So the rule itself does not specify a certain number of days. However, the general rule of thumb is that 10 days prior to loan closing is considered reasonable. I've given you the site to the Federal Register where you can find a few interagency FAQs regarding flood insurance requirements. There is some preamble discussion that mentions the time frame requirement that is of interest here, and it basically says that what constitutes reasonable notice varies according to the circumstances of particular transactions. Things to keep in mind are that a borrower should receive notice with enough time to make sure that the borrower has the opportunity to become aware of the borrower's responsibilities under the NFIP, and two, where applicable, that the borrower can purchase flood insurance before completion of the loan transaction. And it also indicates that the agencies generally continue to regard 10 days as a reasonable time frame. And this is another one where the credit union needs to keep a record of the receipt of the notice by the borrower and the servicer for the period of time that the credit union owns the loan. Finally, another area that sometimes trips credit unions up is using a prior determination that is too old. Generally speaking, a prior determination can be used when increasing, extending, or purchasing a loan secured by improved real estate or a mobile home, but there are some conditions. So the conditions are that the previous determination was recorded on the proper form, that there hasn't been a new flood map since the prior determination, and the prior determination can't be more than 7 years old. And to find these restrictions, you have to go to the law itself, so I've given you the citation there because sometimes we get questions over at NAFCU, where that's coming from. So I've given you the citation. So that's it on the flood violation side, and with that, I'll turn it over to Gigi.
Thank you. Okay, so this next topic tends to create issues for a number of credit unions. The Secure and Fair Enforcement for Mortgage Licensing Act, or SAFE Act, mandates a nationwide licensing and registration system for mortgage loan originators, and that system is known as the Nationwide Mortgage Licensing System and Registry. For short, it's referred to as either the NMLSR or the registry. Much easier to say. In regards to the SAFE Act, some of the common violations cited during an examination do include inadequate, outdated, or no policies and procedures, failure to make a registered MLO's unique identifier available to consumers in a practical manner, failure to establish a tracking system for monitoring compliance, and failure to provide for annual independent testing. I won't be covering the SAFE Act in full detail, but I will discuss the requirements that tend to cause these violations and a helpful way to look at and break down the SAFE Act. Okay, first, the SAFE Act is located at 12 CFR Part 1007 of the CFPB's Rules and Regulations. The SAFE Act specifically prohibits an individual who is employed by a depository institution from engaging in residential mortgage loan origination without first registering as a mortgage loan originator and obtaining a unique identifier. Specifically, all credit unions and their employees who are MLOs making residential mortgage loans are covered under the SAFE Act. And under the SAFE Act, an MLO is an individual who both takes a residential mortgage loan application and offers or negotiates terms of a residential mortgage loan for compensation or gain. What NAFCU has seen with the SAFE Act is that a number of credit unions struggle with determining who is and who isn't an MLO under the definition. And the decision as to whether an employee is an MLO is going to be very facts and circumstances based. So it is a good idea for the credit union to review the regulation and also Appendix A to the regulation to make the determination. The regulation and its appendix provide a number of specific duties MLOs typically perform in the course of originating mortgage loans, and also it provides some assistance on what the term MLO does not include. I do want to mention that the SAFE Act does have a de minimis exception that exempts those that technically do meet the definition of MLO if they meet two conditions. First, the employee has never registered or licensed through the registry as an MLO. And second, the employee acted as an MLO for 5 or fewer residential mortgage loans during the past 12 months. If the employee meets both of these conditions, the SAFE Act registration requirements do not apply. I find it easiest to review compliance with the SAFE Act by starting with the annual audit requirement, since all other requirements are interconnected. The SAFE Act requires independent testing for compliance to be conducted at least annually, and it can be done by the credit union personnel or by an outside party. The regulation does not go into much more detail or provide a checklist of what this testing or annual audit should entail. However, the purpose of the annual audit is to ensure that the credit union has sufficient policies and procedures in place to address the requirements of the SAFE Act. So the compliance officer or the internal auditor will need to examine the requirements of the SAFE Act and whether the credit union has complied with these requirements. As I already mentioned, there is a registration requirement. Both the credit union and its MLOs are required to register with the registry. It is the responsibility of the credit union to ensure that all individuals in its employ who meet the definition of an MLO are registered before performing as an MLO. Registration also includes obtaining the unique identifier and also maintaining the registration. When completing the annual audit, some potential areas to consider when determining compliance with the registration requirements are: do policies and procedures provide a method for determining who meets the definition of an MLO? Did the credit union ensure that all MLOs were registered before allowing them to act as an MLO? Are any employees acting as an MLO that are not registered with the registry? And that's important because here we're talking about the de minimis exception, which I already discussed a moment ago. You may have a situation where, you know, technically somebody does meet the definition of an MLO, but if they meet the two conditions of the de minimis exception, then that would be why they are, you know, acting as an MLO without being registered. If the credit union utilized the exception, did it do so in a non-evasive way? And again, this is an important question to ask because the SAFE Act prohibits engaging in any act or practice to evade the limits of the de minimis exception. And here, for example, using multiple employees for origination to avoid meeting the exceptions threshold would be prohibited. Next, maintaining registration. The credit union should have procedures that address the registration process, both for the credit union and for MLOs. The credit union and its MLOs must annually renew registration during the annual renewal period and update the registration within 30 days from when any information required by the registry becomes out of date. For instance, there are requirements to update information such as a change in name or if somebody's been terminated from employment, that needs to be updated in the system as well. Some areas to consider here are also listed on the slide, and they are Did the credit union and its MLOs renew registration within the annual renewal period? And I don't think I mentioned it already, but the renewal period under the SAFE Act is defined as November 1st through December 31st of the year. If not, did the MLO complete initial registration between July 1 and December 31? The SAFE Act does provide an exemption to annual renewal for that particular year where the MLO completes his or her initial registration less than 6 months prior to the end of the annual renewal period. Does the credit union have procedures addressing the renewal process? How about procedures addressing the account maintenance? And was the 30-day time frame for updating information with the registry adhered to, if applicable? Next is use of the unique identifier. At the time of initial registration, each MLO will be assigned a unique identifier through the registry. The unique identifier must be made available to members in a practical method and manner. And here some areas to consider are whether the unique identifier was obtained by each MLO, and also are there procedures in place for providing the unique identifier to members, for example, upon request or before acting as an MLO or through the initial communication with a member. Next are the policies and procedures. The credit union must have in place written policies and procedures addressing the SAFE Act requirements. The minimum requirements that must be set forth in the credit union's policies and procedures are set forth in subparts A through I of Part 1007.104 of the SAFE Act. And they include all of the items that we've already discussed here today, plus more, which I have listed on this slide. I do want to mention that this is just an abbreviated way to look at SAFE Act compliance, and depending on your credit union's size and complexity, your focus may be more or less on one requirement over another. Also, there may be other items that I did not address here that your policies and procedures should address. Before I move on, I do want to say that at this point, there is a common question that I often have heard, and that is, when must you perform the annual audit? And unfortunately, the regulation does not provide a date for that. So whether you complete it during the annual renewal period or on the anniversary of the initial registration period or some other time chosen by your credit union, it may be a good idea to put a reminder on your calendar or possibly list it in your policies and procedures as to when that audit will be completed in order to ensure that the audit is not forgotten.
Thank you, Gigi. We have another poll question, and this is covering the information Gigi just went over. So here it is. My credit union completes the annual SAFE Act audit, 1, during the renewal period prescribed by the SAFE Act, B, during the anniversary of initial registration, at some other time during the year, or I'm not sure when, not applicable, credit union has no registered MLOs. There's no wrong answer. It's just that we want to see how you're doing. And let's see what everybody says. Give me a few more seconds. We're going to see how this comes out here. Let's see. Okay. So how does it look, Gigi?
Not bad. We've got a number of people who do it during the renewal period and also at some other time during the year. And it looks like we have a little bit of everything, which I kind of expected.
Okay. Sounds good. We're going to move on to our next speaker. I'm sorry, ladies and gentlemen. Patrick is going to discuss member information, safeguards, and privacy. So I'm going to turn it over to Patrick. Patrick?
Okay, thank you, Catherine. So now we'll discuss member information safeguards to support compliance with the Gramm-Leach-Bliley Privacy Act commonly known as GLBA. This slide provides an overview of the guidelines for safeguarding member information from NCUA Rules and Regulations, Part 748, Appendix A. Cybersecurity, of course, is a top priority right now, and over the next year, NCUA will be updating its exam procedures based on the new FFIEC Cybersecurity Assessment Tool. For a detailed discussion on the assessment, be sure to attend NCUA's July 29th webinar, which is next week, Wednesday at 2 p.m. An NCUA press release with event details just went out today, in case you haven't seen it yet. Last year, NCUA participated on the FFIEC pilot cybersecurity assessment that highlighted several basic GLBA privacy compliance elements all credit unions need to have in place. These serve as your foundation for developing a strong cybersecurity preparedness program as well. First, make sure that your risk assessment of threats to member information meets the criteria listed here. A spreadsheet with several columns can work perfectly fine to document this risk assessment. The resources listed here can be useful to identify threats that apply to member data. Also be sure to consider NCUA or FFIEC guidance that highlights the most current cyber threats on an ongoing basis. Credit unions at a more advanced level may want to look at NIST Special Publication 800-30. In Appendix E, this free government resource lists 6 full pages of threats to consider. So that could be very helpful. And I can also provide some examples of common findings for the GLBA risk assessment process. First off, we may see a high-level policy, but there's no actual risk assessment performed. It's just a policy saying that the credit union will do a risk assessment. The risk assessment also needs to be updated for changes and periodically due to the rapidly changing threat environment. Another common finding would be to see a risk assessment limited to the IT area while not considering physical security and paper documents. For example, unsecured loan files that unauthorized persons, such as cleaning staff, could easily access. The last common finding to be aware of would be to make sure that the risk assessment is actionable. This includes identifying control gaps, responsible staff, and establishing timetables for corrective action. Credit unions must also have a written information security program to manage and control risk. While this program should be tailored to asset size and complexity, the topics listed here apply to most credit unions. What that means is your examiner will mostly expect to see them addressed in your written information security program. Complex credit unions require a more extensive information security program that probably addresses a number of additional topics beyond this slide. However, I'm not aware of a single comprehensive listing for all elements of a credit union member information security program. Finally, all credit unions must have a written program to address member data breaches. The program elements outlined above are from, or I should say below, are from NCUA Rules and Regulations 748 Appendix B, which contains very specific program elements to address. We should note here, though, that also law enforcement notification should be addressed and may delay member notification. In summary, while NCUA Rules and Regulations uses a guidelines approach for safeguarding member information, there are 3 minimum GLBA requirements all federally insured credit unions must have in place. Those are a risk assessment of threats to member information, a written information security program commensurate with credit union size and operations, and a written response program for unauthorized access to member information. And now I'll turn it over to Gigi to discuss the remainder of our section on privacy compliance.
Thank you, Pat. So one of the most common violations stemming from the privacy regulation, which is Regulation P, is that the annual privacy notice is not being provided at least once during a 12 consecutive month period. Not only must the credit union's annual privacy notice be delivered annually, but it also must be delivered so that each member can reasonably be expected to receive actual notice in writing, or if the member agrees, electronically. This requirement can be satisfied by either hand delivering or mailing a printed copy to the last known address, providing the notice electronically with proper consent under the e-Sign Act, or by using the newest method of delivery, which is posting it on the credit union's website, if a number of conditions and operational requirements are first met. The next two slides focus in on the new alternative method of delivery, which went into effect on October 28, 2014. Before using this method, which allows for online posting of the annual notice rather than individual delivery, the credit union must meet 5 conditions. I'm not going to cover in full what those conditions are since they are listed on the slide, but what I will say is generally if the credit union is not required to provide an opt-out on its privacy notice, the credit union's privacy notice has not changed since the credit union provided the prior notice, and the credit union uses the model privacy notice, then it's likely that the credit union does qualify to use this new alternative delivery method. But it doesn't stop there. The 5-part test only tells the credit union that they qualify to use the alternative delivery method. If the credit union does qualify, then there are pretty straightforward operational requirements that the credit union must also follow. And because of time constraints, I'm not going to go over those requirements, but again, they are listed here on the slide. And what I will say is that if you do want more information on whether your credit union qualifies to use this alternative method, and also if you want to know more about these operational requirements, NCUA did release a very detailed alert, and that's Alert 14RA11. And, it's very helpful. So that is located on NCUA's website.
Okay, thank you, Gigi. We have a final poll question here. And it says, the annual privacy notice must be provided at least once during 12 consecutive month period. Is that true or false? This is the final poll question. And remember, to take the quiz, there are 2 magenta icons at the bottom of your screen. One of them has a test in it. You can hover over it to see which one. The other one will show you your progress as far as answering the poll questions and timing to listening to the webcast. Well, let's see what everybody says. Wow. All right. So what do you think?
Well, the answer is true.
Okay. Thank you, Gigi.
You're welcome.
So now, as I mentioned, here's our contact information for the Office of Small Credit Union Initiative. I'm getting ready to push a survey out to you, too. This is NAFQ's contact information. Now, you must be a member credit union to take advantage of their direct compliance assistance, but that's the information for NAFQ. Also, I wanted to remind everyone of our upcoming webcast. Join us next month on the 19th. We have internal controls and small credit union accounting. Wonderful presentation. You don't want to miss it. And then in September, participation lending, October, data mining, November, auto lending, and then finally December, getting started with mortgage lending. So here comes your survey. Please take the survey. We're going to leave the console open for the next hour so that you can take the quiz. We thank all of our we thank our guests. We thank our NCUA staff, Patrick Truitt, Matthew Nixon, Judy Graham. We thank our NAFQ special guests, Gigi Bahur and Bernadette Claire. We thank Franz, who's our behind-the-scenes person. We thank Chisanga, who's been helping me with the Q&A, and Hector, who's one of our interns. I'm Catherine Baxter. Thanks again. Have a wonderful day and a great week.